Hi guys, welcome to Gold Today. This video is brought to you by the coach. Remember always our job is to make you rich. If you are a new subscriber, welcome aboard and thank you for joining us. If not yet, please hit the subscribe button. We are going to start our video with the economic calendar. On the economic calendar for Tuesday and from the United States, we'll be waiting for the following economic headers to be released. We'll be waiting for the manufacturing PMI for month of August, ISM manufacturing PMI for month of August, ISM manufacturing employment for month of August, and ISM manufacturing prices and the construction spending. Usually these numbers are hard to beat because it's related to the manufacturing simply, and maybe you would bet safely on gold to go up against these numbers. That's all for the economic calendar. We'll move on now to the numbers. On the last trading session of Monday, we have had a trading range from 1519 to 1533. Numbers are rounded and the market is still open. Gold spot is expected to print a close price above 1529. The numbers rounded and the market is still opened. Gold is trading in a bull trend above its all daily simple moving averages, and what matters for us is the 20 days daily simple moving average located at 1519. This market is completely bullish above 1468, the 50 days EMA. We are overbought on the weekly and monthly charts with high readings, and the supports are seen at 1519, followed by 1508, and then 1500, and then 1490, and the resistance levels are seen at 1533, then followed by 1542, then 1548 number. That's all for the numbers. We'll move on now to the trading strategy. In our video for tonight, we are going to discuss and analyze with facts the 10 reasons that makes the coming recession a mighty and unavoidable one. We are going to start right away with the first reason we are all familiar with, and we do remember the tweet made by the US President Mr. Donald Trump the day the yield curve inverted, as he urged the Federal Reserve Bank to cut interest rates immediately by 100 base points and to start immediately the quantitative easing. We know that Trump's tweets lately been manipulating the market and moving the prices against the technical platforms, but you got to know when the man is in real pain or he is just bluffing, and I believe they are in real pain. Second reason. It's been reported that the White House been discussing or thinking of tax cuts as additional mean to help the common people and investors. And the question is, why would you cut taxes while you do have a growing budget deficit? And the other question is, and if you are really planning to carry out any tax cuts, how you will finance the growing budget deficit? For the third reason, it's been reported that 8,000 retail shops were shut down from the beginning of the year in the United States, a number that is not seen in any period that is before 2008 financial crisis. And the fourth reason, it's been reported that so many Americans are struggling to make their monthly payments against their outstanding obligations with banks. Again, you don't need to wait until a serious shit takes place and the bank or two declares bankruptcy. In fact, more than 3 banks got bankrupted in China itself, but in China they don't like to call things by its names. They said it's been taken over by other banks. For the fifth reason, and now we are going to talk about something that is backed with numbers. Speaking of China, the Chinese economy, as I said once, it's highly leveraged. And again, to make it clear, it's the most leveraged economy in the world and the modern history of finance. Corporate debt in China is about 155% of the GDP. The monthly figure issued from China shows that the industrial PMI is falling for the 4th month in a row and dipping into the destructive territory, which means that China technically is in an industrial recession. One might argue that the trade deal once reached, things are going to reverse back to the constructive zone. Well, I don't care what is the cause. Is it the trade war or that the stars are not aligned? All what I care about is that the numbers are falling, and most likely they will be keep falling more and more. Reason number 6, and we are going to talk also about something that is backed with numbers. The consumer sentiment in July fell to multi-months reading of 92.1, the lowest in the last 7 months. Sure, markets did not really show any real response. Rather, the US dollar kept rising, backed by what I don't know. Actually, the US dollar should have fallen after such a result. For everyone is hiding still behind the slogan that the United States economy is a consumer-driven economy. I would say, good luck, your consumers seems to be not in the right mood right now. No offense, guys, but I don't want anyone to bullshit me and sell me dreams. I want to survive this coming tough period, and this should be also your target as well. Reason number 7. The volatility is back to the US equity markets, and we have seen the Dow Jones, which is supposed to be trading in a bull trend, losing 800 points in one session, as same as the period that preceded the 2008 financial crisis. Reason number 9. The transportation recession within the United States itself. As reported, the decline is ongoing for the 8th month in a row in the transportation within the United States, and this is by all the means of transportations available in the United States. The 10th reason, which is just an advice for you to watch some interviews from 2008 at the time that preceded the financial crisis, and you will find out that the same dialogue, the same debate, the same conversations are taking which they are taking place right now. They have been happening those days right before the financial crisis. There is no solution that could stop the coming recession from happening. Uh, Maybe you will see a rally in the stock market, the US equities. Maybe you will see a rally in the crude oil, but it's just the market movers or market makers, sorry, are just clearing up their positions and handing over to the retail market. However, technically gold is trading in a bull trend above its all daily simple moving averages and above the trend line. Gold started the week on a gap up following the rising tension in Hong Kong and the implications of recently applied tariffs. Also, we had the three main indices in the United States opened on a gap down. Gold price action is very positive and no reason to question the strength of the trend. My study points, or this is what I wish to see. I wish to see a rise to 1300 to 1533, then down to 1513, then up to 1525, then down to 1500, then up to 1505, then down to 1490, then up and up to 1600, or gold goes directly up and trades above the reversal point at 1555. However, we don't want to be ahead of ourselves. You have to understand that the market priced already a rate cut of 25 base points still to be delivered on September. So traders cannot trade gold so much higher, and we don't want to enter the market at this condition. So better we find a very suitable entry to the market. There will be some positive vibe also around the US equities because the trade talks are going to resume by 5th of September. So maybe gold will decline to 1490. I prefer this scenario actually. Thank you guys for watching. Please share, like, and subscribe, and I will see you tomorrow in another video. Finally, have a look